Good day, everyone. This is the fifth installment of our discussions about long-term construction contracts or construction contracts under IFRS 15, revenue from contracts with customers. So make sure to watch the recently issued 4 videos of the series so that you can very well relate to our discussions. Now, let us begin or proceed. The first topic is all about onerous contract. If you say onerous under our law on obligations and contracts discussions, this means that the contract is burdensome or becomes burdensome on the part of a certain party. Under PAS 11 construction contracts, which was the standard before, when total costs of the contract would exceed the total contract revenue, contract cost meaning the total estimated contract cost composed of actual costs incurred to date and estimated cost to complete would exceed the total contract revenue, which is the percentage of completion multiplied by the contract price, then there is an expected loss. And in that particular case, then we are going to have a loss that is to be recognized immediately as an expense. So this is what is meant when the contract becomes burdensome because there is an expected loss. Remember, under our discussions, even if there is a change, then we have to treat that as a change in accounting estimate that is to be accounted for prospectively, meaning to say that any changes in the estimates shall be recognized only and should only affect the current and future or subsequent periods. The previously reported revenues and expenses shall not be restated. So you have known this under IAS 8, accounting policies, changes in accounting estimates, and errors. Then on the other hand, in the revised IFRS 15, it does not specifically address as to how do we account for the expected losses on contracts with customers. So in that case, we have to refer to another accounting standard, which is PAS or IAS 37, all about provisions, contingent liabilities, and contingent assets. So this has been amended or revised to include onerous contracts as part of the scope. Probably when we had the PAS 11 before, this is not included, but because of IFRS 15, that's why there's a need to include onerous contracts in IAS 37. So there's onerous again when the contract becomes burdensome. This is when the unavoidable cost of meeting the obligations under the contract exceed the economic benefits expected to be received under it. So meaning the cost exceed the benefits. So this is why we have to recognize a provision or liability. So this means that we have to recognize a loss, debit, and credit for a liability account. Now, in terms of the value, how do we value that? It will be the lower of the cost of fulfilling it or performing the obligation and any compensation or penalties arising from failure to fulfill it. Meaning to say, we have to select the lower value of the two. And this would be the least net cost of exiting from the contract. Then there is a phrase here or sentence, before a separate provision for an onerous contract is established, an entity recognizes any impairment loss that has occurred on assets dedicated to that contract in accordance with PAS 36 impairment of assets. So this is now a provision in relation to this standard because remember in the construction contracts, still non-current assets will be involved and these are not reflected at fair value, so they have to be impaired when the carrying amount exceeds the recoverable amount. To continue, here's an example of an onerous contract. So in order for us to know as to whether a certain contract becomes onerous, we have to compute first the difference between our contract revenue and the estimated costs. So in this particular situation though, the contract revenue really is our contract price and the estimated costs, the total would be composed of the actual cost incurred to date and the estimated cost to complete. So this is where the situation is being shown here. And then we do our calculation. So contract price of 6 million, total contract cost expected is 4 million. In that case, that is still the beginning, so we are going to read further. In case that ABC company is the construction company, cannot perform the contract or would cancel in the contract, so there is a payment of 15% penalty. On 20 or in 20x1, ABC company incurs total cost of 1,860,000, and the revised estimate of the total contract cost is 6.2 million pesos. So I think it's clear now at this point in time that at the onset of the contract, it's possible that there are certain estimates that are there. But at the end of an accounting period, it's also possible that there can be changes of values and we have to incorporate such. So in this case, it's 6.2 million pesos as revised. So to compute, we have contract price, which is same from the beginning and at the end of the first year. And the estimated total contract cost is 6.2 million pesos. So that the net cost of fulfilling the contract is 200,000 loss. Then this is the cost of fulfilling. This is from here. You can recall letter A. While letter B is 6 million pesos times 15%, 900,000. Now we choose the lower amount or value. It's also possible that this is not around, like the penalty. It's not part of the provision. So we only have to consider the net cost of fulfilling the contract, which is the negative value. Also, we should be reminded that this is applicable when there is a loss again. If there is no loss, so meaning the contract is not onerous. So meaning no analysis like this. Then the amounts recognized in 20x1 profit or loss are computed as follows. So this is the method 2 that I've told you, which is something that I would say it's an additional because I prefer, hopefully it's here, the method that I want. Oh my, it's not here so far. Anyhow, so the point is that we can actually just go back pages before and look at that formula wherein that's going to be total contract price less the estimated total contract cost equals the expected gross profit. We multiply that with the percentage of completion, and that would be the gross profit to date less the gross profit in the prior years, or by the way, loss or losses, then that would be the gross profit or loss this year. So that's the formula that I would like to. However, whether we use the first formula or the second formula, it's going to be actually producing the same answers, provided it's a profit or there is gross profit. And this is the reason why I mentioned in the previous discussions that I loved method 1, which I actually discussed a while ago, the formula just a while ago, because it's powerful. It would really result to the desired answer. And method 2, this method is just something that would just be an additional way or manner of computing it. I repeat, the two methods would result to the same answers if ever it is profitable. If it is not, then method 1 is more powerful. So what's the point of using this anyway? This is okay if ever we would like to know how much really is, for example, the cost of construction as squeezed if you are, or if we are using, for example, the output method. So make sure to check that out in 4. So if you use output method, we have to squeeze this. And then this is also used if ever we would like to get, for example, the income statement format, because we have here the revenue less the cost of construction. And this is also good if, for example, we are going to determine how much really is the provision for onerous contract as squeezed. So remember, we've said that the moment that we know under the analysis, for example, we have 6 million minus 6.2 million, that there is loss. Remember, we do not make use anymore of percentage of completion. That's the rule. However, if, for example, there is really a loss, and then we want to have this presentation. This is okay, so we still compute the percentage of completion, and it is at 30%. So cost incurred to date over the estimated total contract costs. And we get the revenue. This is the first year, so no revenue in prior or previous years. Less the actual cost incurred to date equals negative 60,000. This is a loss for the year. Then remember, the loss really for the year is 200,000 as computed. So in other words, the provision for onerous contract is 140,000. However, actually, there's a shortcut for this. Remember, the percentage of completion is 30%. So if we get 200,000, meaning the 30% is the loss for the year, while the 70% is the provision for onerous contract. So I just said this in advance. However, you will realize, or we will realize this as we go along the way. So I am just stating this in advance again. So percentage of completion done. Next, what about for this case? So we have the 10 million price, and then we have 11,800,000 estimated total contract cost. Therefore, there is a loss from the contract. The contract becomes onerous, and therefore there is a need for us to compute the provision. So this is really the first thing that we should do, guys. Determine first if the contract is profitable. If profitable, then okay, we can use method 1 or method 2. But if not, for example, this is losing onerous, so we have to use method 1 for computation of the profit or loss, and we can do the shortcut, just multiply that with, again, the percentage, like 200,000 times 70%, which is 100% less the percentage of completion. That is the provision for onerous contract shortcut. And this is the long cut. So meaning this is squeezed. And then the method 2 is that usage. But we cannot, or we can just set aside the usage of method 2 if, for example, method 1 has been used if the contract is losing. Okay, so clearly from this illustration going back, this is a losing contract. And then in the second year, though, okay, the requirement going back is this, the lose from the contract. Okay, so I thought there is a continuation, and this is the continuation, but it is not. So this is just another problem. So for another problem, we have here ABC company, which is 1 million pesos fixed price contract, and here are the details. So for the first year, because this is a friendly illustration, so we can really see that it is still profitable. 1 million minus 800,000, that's 200,000. While in the second year, it becomes onerous. 1 million minus 1,100,000, that's negative 100,000, and it is shown here. So in 20x2, the contract becomes onerous. And then to be able to compute our expected cost of the said provision, remember, this is the rule again. It should be the lower of the cost of fulfilling it, which is based on the performance under the construction contract and any penalty provision. Because we don't have a penalty, which means that the 100,000 loss is our least or lesser net cost of exiting from the contract. Now, the shortcut a while ago that I mentioned actually is very applicable if ever the lower amount is the expected loss. However, if the lower amount is the penalty, this would not be applicable. Like simply, for example, 100,000 times the net of the percentage of completion from 100%, that's not going to be applicable. So allow me to go back once again. Here I said that the shortcut is 200,000 times 70%, which is net. However, if the lower amount is, again, the penalty or any other cost, then we are going to really make this particular format. So we have to respect method 2 then, because the loss for the year would be, for example, the value here, which is really the loss. And then let's just say that in the example here, the penalty is, let's say, 100,000. This means that the provision is the difference of 100,000 and the loss. So that's going to be 40,000 only for the said provision. So that's how it is then for the computation in case that would be the provision for onerous contract, which also means that the loss then is equivalent to the lower of the two, the cost of fulfilling the contract and any penalty for letter B. Let's go back to the entire phrase. Any compensation or penalties arising from failure to fulfill it. To continue, this is an illustration of computation of profit or loss from this particular problem, second year. This is illustration 3.1. And then this is method 2. So contract price times percentage of completion using the contract revenue to date and prior years equals the contract revenue for the year less cost incurred each year, because the contract revenue for the year is already current, so we have to deduct only the current. However, if, for example, you decide to deduct here the cost incurred to date, still we will be getting the gross profit cumulative, and we just have to deduct the gross profit in the prior year to get the profit or loss for the year. Now remember, in this particular case, the lower value or expected profit or loss is 100,000. And so how do we compute then the provision for the onerous contract? And then the gross profit or loss for the year is 125,000. So the provision for the contract then is 25,000. And that will be deducted because it is also a loss item. So meaning it is an additional loss in this case. So for a total of 150,000 loss for the year. Also, as said, remember 100,000 is the expected profit or loss. Multiplied by 25%, that's going to be 25,000, which is also the value as a shortcut again for the provision for onerous contract. So it is up to us then if we are going to use the long method or, for example, the shortcut. However, whether we use the long or short, again, the results would be the same. And then we should also be reminded about that this is really applicable if ever our basis for the lower amount is the profit or loss for the contract overall. However, if it is like the penalty, which is the lower, so that will be our basis then. But we will still have to multiply it by the percentage to get the shortcut. Anyhow, so to continue, there are many ways of presenting the profit or loss. However, we are going to get the same values anyway. So this is how we get the percentage of completion. Remember, guys, I've told you that if the contract is already losing, like the 20x2, supposedly we should not compute the percentage of completion. So this seems we are contradicting what we have said. Well, it's actually not, because we said also that we are just doing this for the sake of computing the provision. So overall, if we compute the profit or loss, this would not have an impact, which can be shown here on the subsequent illustration. Anyhow, just a tangent moment though, for the cost incurred each year, that is simply cost incurred to date minus the cost in the prior year. So can I go back here? So if this is the cost incurred to date, 825,000, if we deduct this, so 625,000 then is the cost incurred to date. And it is also important to highlight though, because we are closing the discussions now for construction contracts, that cost incurred to date, if the word or with word to date, it is really cumulative, but estimated cost to complete is really like from this point and up to the future. So meaning we do not add the two values because it is an estimate done at the end of the accounting period. All right, and going back. So the loss to be recognized in 20x2 is the 100,000 loss overall for the contract, negative 100,000. And then the profit is 50,000 prior. So that's going to be negative 150,000. Let me go back. So if this is the 50,000 profit for 20x1, and then let's say we are using the method that I've mentioned a while ago, which is method 2, but this is not like the presentation that I really wanted to see. So it's again going to result contract revenue to date 750,000 less cost incurred to date, which is 825,000. So that's going to result to a certain amount or value then. So that's going to be negative 75,000. And then minus 50,000. So remember, this is a loss here. So gross profit loss to date less gross profit or loss prior year. So the positive will become negative. So we have to take note of that aspect though. So if it is a loss then in the prior year, so that would be less negative. So double negative would be plus. Anyway, negative 75 minus 50. So that's going to be negative 125 in thousands for the gross profit or loss. And then which means that our provision is 25,000 from the 100,000 times 25%, and really the profit or loss for the year is 150,000. So I am like expounding and revising this presentation though to be favorable to what we have known. And then which if we use method one, which I really like, it would really result to this. So 50,000, which is a plus here. And we can notice that the percentage of completion is no longer applicable. It is NA at this point in time. So we have here the negative 100,000 and the profit or loss recognized in prior years is 50,000. This would become negative if this is less. It's a minus. So negative plus the negative is negative 150,000 pesos. And if you're going to combine actually the two, it would result to negative 100,000 overall for the contract because remember, this is cumulative for the contract. And this asterisk again is that if ever the contract is losing or has loss or incurs or incurred loss or had loss or losses for a particular year, it becomes onerous. Therefore, the percentage of completion is not used or ignored. All right, so I hope that is clear. And then going back here, so negative 150,000, the provision is 25,000. All right, so that's the case though that we should be taking note about the case. Okay, so then also to highlight, remember this is going to be confusing. We are seeing this particular illustration here, 125,000 gross profit or loss for the year. And then here we are seeing that the profit or loss for the year is 150,000, which is actually synonymous or related, very related. This is the profit or loss for the year, and this is also the profit or loss for the year. So if we are using this formula, we'll be saying that this is really to be scrutinized further. So if 100,000 times 25% is 25,000 provision, so that's going to be, of course, a loss. The 125,000 really is the gross profit or loss. It's really a loss here. So gross loss for the year. So that's also a way of connecting this one to this part here. And as said, we can do the shortcut and we can see it here. So for A, the net provision recognized in 20x2 is 25,000 as said, right? So loss for the year and the 125,000 for the year. Or you can also multiply that with the percentage of completion as said. Or there's also another way that we've actually seen a while ago. If we are just going to use the percentage of completion if we would like to. So the provision for onerous contract is like the balancing figure. However, again, this is not advisable, this usage of percentage of completion using method one. Again, it's because if supposedly it is already losing, we should abandon the usage of the percentage of completion. Okay, so I hope that is clear. And then there's also another case here at the bottom. This is all about a reversal of provision. When can a reversal happen? This happens when on the next year or years, the contract becomes profitable. Therefore, it is no longer onerous. So we can see this, an extension of illustration 3.1, wherein from 100,000 loss here, it actually now has 1 million minus 950,000, that's 50,000 profit. So the contract now is profitable overall. And so we can see it here. And if we are going to compute the gross profit or loss for the year, these are the values. So this is now 125,000 here. And we can notice that the provision for onerous contract is reversed in the next year. So just to be able to recompute the values. And the profit or loss here, 50,000 negative 150,000, that's negative 100 plus 150. If you are going to total, that would result to 50,000, which is really the total profit or loss on the contract. Again, this is really applicable if ever we would like to highlight the provision for onerous contract, because even if in the second year the contract is already losing, we use the percentage of completion. So I would suggest it's like a balancing figure. Then I would use method 1, and whatever is the net cost of exiting, I will have to multiply that with the percentage of completion, and that would be the provision for onerous contract, because that is going to be the loss for that particular year. Okay, then percentages of completion, clearly the third year is 100% because the contract is completed. And for profit in 20x3, it is squeezed here. So we can also do this analysis, but we can also do the tabular if you would like to. Then in 20x3, the contract is profitable. Then the gain on reversal of provision is also obtained from the gross profit or loss for the year at 125,000, and the profit is 150,000 or 150,000. So this is also the squeeze amount, or basically it's like the value of the previous provision then to be reversed in the current year in which the contract is already profitable. Okay. What about if zero profit method? So remember, under zero profit method, we are going to recognize only the revenue equivalent to the contract cost. Therefore, the profit is literally zero, or again, the profit is literally zero. Then here's an example. So to illustrate same example though, then we cannot reasonably determine the outcome of the performance obligations in the contract. In that case, we have to use zero profit method. To continue, here's our analysis for 20x1, 20x2, and 20x3. So same as the previous problems. And then in 20x2, it becomes onerous, of course, because the contract now is losing. And then using the same analysis in which we have to select the lower or the lowest, if there are three, of the cost of fulfilling the contract, which is negative 100,000, and then the cost of penalty if there is, but there is no cost of penalty, therefore this is our amount of loss. So negative 100,000, therefore the provision is also negative 100,000 because there is no gross profit to be recognized then. Because supposedly we have to multiply this by the percentage of completion, and then that will be normally the gross profit, and whatever is the value here times the percentage net from 100%, or that is whatever is the percentage of completion deducted from 100%, then whatever is the result of the percentage will be multiplied to the lower of letter A and B. Again, cost of fulfilling the contract and the penalty, then that will be the provision. So again, in this case, zero profit because there is no profit or loss. Here, because the contract is under zero profit method, therefore it's going to be equivalent. So I just went around the bush, or going around the bush, just to be able to emphasize the point, but hopefully that is clear. For 20x3, because this is really the end of the contract, so that's the time that we have to recognize now the gross profit. So this is a unique characteristic of zero profit method. And because the contract is profitable, so there is a gain on reversal of the previous provision, which is equal in amount. Overall, guys, if you can notice here, this is zero, this is negative 100,000. If we add this with 150,000, then 50,000 is the profit for the year. So whether we use percentage of completion method or zero profit method, the results would be the same. It's just a matter of recognizing of the gross profit or loss as to when. So the timing or the time of recognition. And then what is similar with percentage of completion and zero profit is that they have or they will recognize any loss immediately. But for zero profit, in case that there is a profitable year, it will be a zero for that year. Hence the term zero profit. Remember the concept of prudence and conservatism in our conceptual framework, wherein that we anticipate for more losses and we anticipate no profits. So this is the application of that concept. It is because we cannot determine the outcome of the performance obligations reliably. So that's the point of this. Also, as an additional input, we can determine the revenue for 20X3 by squeezing the total contract price with the revenues from the 2 years, which are equivalent, by the way, to the cost. So this analysis is not applicable to percentage of completion method. So refer to that discussion or those discussions. Then the profits, of course, contract price less the cost incurred on the contract. Then total profit is here. So 50,000 pesos, also shown here. All right. So this ends our discussions for construction contracts. Hopefully you've learned something from this session. And I'll see you next time for another session involving advanced accounting or accounting for special transactions. Thank you very much.